We have a business that's making money outside of being a hedge fund. We teach people how to build trading algorithms. We have now a library of trading algorithms that a lot of people can use, and some that are actually performing quite well. We had this one really interesting algorithm that I think was up 150% in like 2 months. If you want to run this thing, it's super easy. You can get an algorithm up and running in I get new ones up and running in like a minute.
Really impressive. I mean, those returns. Nowadays, I think a lot of people are a little antsy or impatient to make returns. Like they want to 5x their money tomorrow. You know, there's collaboration, there's competition, but then that middle ground. And I think that's where the magic happens.
All right. Hey, Raul, how's it going? Good to see you again.
Great, man. Good to see you again. Very happy to be here.
Happy to be here too. We have the second episode of our podcast ever, right? Which is awesome. Very cool. Got some good talent here. Today's topic is going to be basically a continuation of what we did last time. So last time we talked about investment strategies that actually make money. This is going to be part 2. Just because last time, I think when we started it, we were like, oh yeah, we'll be able to get through a bunch of different things. We'll try different, so not really fully understanding how long it takes to walk through even one strategy. Okay, cool. So you talked about last time some of the stuff that you're working on with your hedge fund. We've actually been looking into starting a hedge fund too with Lumi Wealth. That's something that, I mean, that's literally the way that you and I met. We went to Fund Launch. Yeah. Shout out to them. I thought it was a fantastic event. Yeah, definitely. So went there to basically start a hedge fund. A lot of people were doing the same sort of thing, and I thought those is incredible people to meet. But I mean, we have a business that's making money outside of being a hedge fund. We teach people how to build trading algorithms. We have now a library of trading algorithms that a lot of people can use, and some that are actually performing quite well. We're more of a research-based company as of right now. We don't take people's money. We don't invest it for them. We're not pretending to be investment advisors, but we do a lot of research. We do have a lot of really interesting things that I think you would be very interested in. Do you want me to show you a couple of them? A couple of things that
I would love to. Yeah.
Okay. So let me share my screen here, and I could show you a couple of things that we've been working on. Because some of this stuff is pretty damn cool. So here's our Discord. We call this our trading signals, right? And basically what it is it's a way of people being able to follow our algorithms and see how they've been performing, right? So we try to be as transparent as possible, really showing what we have. Some of our algorithms are less risky. Some of them are more risky. Some of them are so risky to the point that they make a ton of money and they blow up. Some of them have been, around for quite some time, doing quite well. I don't have some of those other ones. We had this one really interesting algorithm that I think was up 150% in like 2 months, and then blew up, right? Yeah, it's pretty crazy. So we do have like the whole spectrum, and a lot of our stuff tends to be a little bit more on the risky side. Here's one that I've been running for a while. All right, here's one that we call diversified leverage, right? And this one's a pretty straightforward, simple algorithm, but it's been up a lot. You can see here, it started on June 21st. This is real money. This is not fake money, paper trading or anything like that. This is real money. There's my cash in this. And basically, we started on June 21st. Today is what, July 18th, right? So it's been a year and a month, and we're up 37%. If you compare that to the S&P 500, yeah, this one's actually performing quite well. If you compare that,
percent is insane, right?
Yeah. So over a year, the S&P is up 21, right? And we're up 37. So we've pretty much doubled it, right?
Wow.
So far doing quite well. This is one of our oldest algorithms. We actually have a pretty long track record on this, over a year now.
Yeah, that's great.
We have this whole thing called our strategy library, right? So the way that our whole thing works is basically every Tuesday night, and if people want to join, feel free to join us. Check out lumiwealth.com. You can join us on this if you want. But every Tuesday night, we basically get together as a group and we work on building an algorithm. right? So every week we're doing something different. I'll show you some of the latest stuff that we've been working on, which is kind of blowing my mind in terms of the potential of it. This is one of our earlier algorithms, so still pretty mild, but we've created all these different algorithms here, right? So these are like Condor, Martin. We've been kind of obsessed with the martingale concept lately. So we did a Condor martingale, spreads martingale. We're probably gonna do a Forex martingale and a futures martingale sometime soon. We have grid bots, is like a crypto grid bot. We have EMA trending, like trend following strategies. This is like a crypto trend following strategy. We have a Bollinger Band strategy for crypto as well. This is our diversified leverage. We have a lot of different algorithms in here, and they're all like really easy to investigate and use. So say, for example, I'm going to show off this diversified leverage one because I showed that result. This is diversified leverage, right? Go in here with our disclaimer and all that. We're not investment advisors. We're, analysts and whatever. If you want to run this thing, it's super easy. You click on this button, right? Run on Replit. It loads it into Replit. And then basically you just put in your API keys and you're good to go, right? That's all you have to do. It's like super simple. You can get an algorithm up and running in maybe, I get new ones up and running in like a minute. You know what I mean? As long as you have a brokerage account, super easy.
Normally when you find a successful algorithm, do you try and build on top of that, or do you find that starting from scratch and building off a new idea, is better?
Yeah, that's a very good question. So a little bit of both. Lately we've been trying to build on existing algorithms a lot, right? Because it's like we've found success. And we're like, okay, how do we refine it? How do we make it better? Like I was telling you about our other strategy that just shot up like crazy, right? It was up like, 140% or whatever in 2 months. And then it blew up. So it's like, okay, well, how do we prevent it from blowing up? How do we have our cake and eat it too?
Yeah.
Right. And we constantly refine this and make it better. So we do spend a lot of time refining algorithms. And then every once in a while we'll make some new ones. I think we probably spend more time refining, maybe 70-30 on.
Oh, wow. Okay. Yeah.
It takes a while until you kind of hit the sweet spot. 'Cause even if you have a good idea, it takes some time to actually refine it and make it like work properly. Right.
So this algorithm that blew up, would you start playing with the risk management parameters?
Yes.
There?
Sure. So that algorithm, let me show you a couple of back tests that we ran with it. Actually, first, before we jump into that, this is that diversified leverage algorithm, a long-term back test, 29% a year, right? That's versus S&P 500, which was doing about 14% a year at that same time. So about double the returns per year. And then that compounds over time, right? So then the strategy, 4,000% over this time period, which was 2020 to 2024, that's 14 years, 4,000%. That's what, 40 times your money. Wow. Right. Versus S&P, which also did very well, but only 5x your money, right? So it's quite a substantial difference, right? There's an increase in volatility, increase in risk that doesn't come for free. But I'd say all of our metrics are risk adjusted, and the risk adjusted metrics are all pointing in the right direction. They're saying it's better than just leveraging the S&P. We actually have more of an alpha from it, right? You get held up by things like the Sharpe ratio or the ROMAD. Not a lot of people use ROMAD. We use it. It's return divided by max drawdown. Kind of see that. It's less correlated to benchmark. It's a bunch of stuff. So that's our diversified leverage algorithm. But you're asking about our other ones, right? So the one that I was telling you about specifically, we call our Condor martingale. So this is it right here. This is our strategy library. You can bounce around. You can see all of our different strategies, how they perform. You can go to the bottom here too. This is the back test for it. 144% a year for this specific configuration. But we've been refining this over time, right? And we're like, well, how can we make this thing perform better without the chance of it blowing up or anything like that, right? So here's like what we do. We'll get into this class on like a Tuesday, right? Tuesday nights. And people will say, okay, well, what if we change this and what if we change that? here's all the parameters this one uses. For example, we call this one Condor Martingale 8. This version 8 of the specific algorithm, right? And this one uses a 28 delta. I'm actually thinking about tweaking this a little lower. This is something I'm going to be working on today. This is the quantities that we use because the martingale, every time it loses, it like doubles up, right? In this case, well, almost triples up actually. So it can get a little risky, this type of martingale thing. And then these are like all the other things that we've chosen. This is a pretty big one. We look at the VIX, right? If the VIX one day is over 11, we don't trade, right? For example, today was one of those days. It's at 13, right? So it's ignoring today. But yeah, when we backtest this is a little bit of a short backtest. It's about a year and a bit, but over that time period, 1,700% return, 976 per year is kind of what it comes out to. Pretty wild return.
Pretty wild return.
Yeah. Again, you're not getting this without the risk. This does have a max drawdown of 35% over this time period. I don't know what that would have been like going back further. We couldn't go back further with this specific configuration because it's using that indicator, the VIX one day, which did not exist prior to this date, right? Which is why it's such a short backtest. And that's something I'm thinking we want to correct. Like, well, what if we use just the regular VIX? There's a bunch of stuff. Yeah, pretty wild return. So we're excited about this one. It's our Martingale 8. Here's another one, Martingale 9, version 9 of this algorithm. More toned down, right? 72% a year.
Insane.
Yeah, it's still pretty crazy. Again, it's a back test. Like when we run in real life, sometimes we'll get different results. Like but when I see results this big, to me, this seems very encouraging because we ran stuff like this and it actually does hit its mark, right? Like our back testing is actually quite accurate. Here, this is different quantities is one of the reasons why it's less risky.
That drawdown is so small too.
Yeah, only 11% drawdown, right? And just there's a bunch of like little things we tweaked about it. What I'm actually thinking for this particular algorithm lately, because of all the like election stuff, I think that's what's causing it. All the election stuff has been going a little crazy. Whatever side you're with, I don't care whether you like Biden, Trump, or whatever. Point is, it's volatile. But yeah, so we have this delta. Honestly, like what I want to do is I want to tone down this delta. I think it'll work a lot better because what this does, and maybe we could talk about that. This trades iron condors. Do you know what iron condors are?
No.
Okay. So an iron condor is an option strategy that looks like this, where you sell a put and a call. You sell here a put and a call, and you buy here puts and calls. And basically, this is where your price would be somewhere in the middle. When the price moves, okay, so let's say the price of your stock is right here in the middle, right?
Mm-hmm.
It starts off, okay? So you start off with a profit, right? As soon as you put on the iron condor, you make money immediately, right? Assuming you did it right? Because when you sell these things, you get cash for them, right? So you're holding on to cash, and the whole point of the strategy is to keep that cash. Right? You want the options to expire, the ones that you sold worthless, and then when they expire worthless, you get to keep that cash. Right? So it's basically a bet that the stock market does not move. If you have high volatility, if things are moving a lot, that's when it starts to actually hurt this strategy. Right? So that's why in periods of high volatility, elections going on, that sort of thing, it tends to get a little, it hurts a little bit, right? However, that is highly dependent on where you actually sell these things, right? Because you can make this spread out a lot more, right? What we're doing with this 28 delta, right? Delta is 28, okay? Is we have this thing very close together. So it's not really, if the market moves by more than let's say 0.6, 0.7%, it tends to lose money, right? If it stays within there, it makes money, and it makes a lot of money very quickly, right? So if we were to put a lower delta, we would actually spread this out more, and then we could tolerate a higher amount of deviations, right? We actually, that algorithm I told you about that made like 140%, like 2 months or 3 months, whatever, it was using a 14 delta, right? So it's like allows for really big price movements to happen, right? And then, and when that happens, we were able to make a lot more money, right? So, so that's one of our strategies. That's our condor martingale. Basically, it's putting on these iron condors. Whenever it wins, it takes its money. If it loses, it increases the bet that it's taking. And the reason why we do that is because it smooths out the curve very nicely, right? You end up making quite a bit of money because it's martingale nature of it. If you're familiar with what a martingale is, do you know what a martingale is? Yeah. Yeah. See, what we do.
Am I supposed to?
Yeah. No, it's a lot of people don't. Most people don't, I'd say. So martingale basically is it started off with MIT back in the day. What they were trying to do is they were trying to beat casinos. And they're like, how do we beat casinos? And they actually came up with a mathematical way that you could actually win at a casino. And the casinos had to respond to this. But basically, if you ever want to win at a casino, easiest way, I do this whenever I go to a casino. You could be drunk out of your mind and still make a ton of money. Or you could lose a lot. But it's usually you win if you're playing you're playing it right. Basically what you do is you go to a roulette table or something that has like a 50-50 odds, right? And you put down the minimum, right? If you win, let's say it's $5, right? If you win, you take your $5, you put down another 5, right? So they're going to give you 10, right? So you're going to take half of that. You're going to leave it at 5, right? If you lose, they're going to take your $5 and now you have to put down 10. You have to double it, right? And then if you lose, you have to double it again to 20. If you lose, you have to double it again to 40. And then what happens is if you win at 40, they're going to give you $80. You've doubled your money, right? You're only playing the 50-50 bets like red, green, or was it red, black, odd, even, whatever, that sort of thing. So you double your money if you win, right? So you win at $40. So now you get 80. You're going to take that $75, which is going to pay for all of your losses plus a $5 gain. And then you're going to put down $5 again. Right. And then when you win, you reset it back to the beginning. Right. That's what a martingale is. That's one of the simplest way of winning at the casino. This is a very long dated strategy. MIT research, I've been doing this for a while. A lot of casinos actually fight against this now because that's why they have maximums and minimums at tables. Right. You ever wonder why they don't let you bet too much money on a roulette table? It's because of that. Right? That's where the rule came from. Yeah.
So that eventually you hit the limit. And
eventually you're out. And you're out, right? Because the martingale, theoretically, if you could do it forever, you will pretty much always win, right? It's a surefire way of winning. The problem is that if you're at a roulette table, you hit the maximum, or if you just run out of cash, right? Doubling eventually gets pretty scary. But the theory is, what's the probability of losing that many times in a row, right? Like if you can put down 10 bets, right? Well, it's 50% times 50% times 50% times 50%. And that becomes a very, very low number. That's your probability of losing, right?
Wait, times 0.5 or do you double it?
Times 0.5. So it's like 0.5 to the power of however many chances you have, right? Okay. So if you have the bankroll to go 100 times, your probability of losing is like fractions of, so you have better chance of being struck by lightning 5 times in a row than losing. You know what I mean? It depends on how long you can go for, right? So it depends on how big your bankroll is. It depends on how much you can, So that's the idea behind this, right? So we're using a martingale and we're investing in condors. Condors generally tend to make pretty good money on their own. A lot of options traders already do that. And then we put a martingale on top of it because it allows us to have a higher probability of winning. Right? If you have a 60% chance of winning on any given day, well, 60, the way you do the statistical math is 40%, the transverse of it, 40 times 40, right? That's your probability of losing. So your probability of winning goes up significantly, right? So it's statistical, right? Yeah. So we did that with martingales. We have a bunch of different versions of it here. This is our martingale 9, right? or this is when we were making Martingale Dine, a bunch of different configurations of it. We made a new one recently using spreads, doing the same thing, right? Where basically a spread is, this is what it looks like, debit spread, is specifically what this thing is doing. This is an option strategy. It looks like this, right? So if the market goes up, you make money. If it goes down, you lose money, but you have a capped loss, right?
Yeah.
Yes, you have a capped gain and you have a capped loss. So this thing basically puts on something like this and says, okay, if you win, you take your money. If you lose, you double up the next time again, right? We do the same sort of thing, right? So this got us some pretty crazy returns too. 437% in this back test, 15% drawdown.
The drawdown, that's incredible.
Yeah, I'd say that's
going back how long?
This is going back also only a year, again, because we have that indicator that's constraining it. But we have been running this for a little bit. So this one is right here.
Just remind me, I mean, a higher Sharpe ratio is better. And Sharpe ratio has to do with volatility?
Yes. Yeah. It's in a simple way of saying it, it's basically returns divided by volatility. If you want to kind of think about it that way. It's the ratio of volatility to returns. The higher, the better. Yeah. So here's actually this strategy running. This is our spreads martingale. We started on July 10th. It is July 18th today. So it's been about a week and it's up 6%. All right. So pretty nice start to it. Right. So these things can really make a lot of money. And it actually made money again today. We don't have the graph of it, but I know it did because it said taking profit. Right. So it made money again today. Right. They're risky, but you run this thing for a while, you start seeing some pretty crazy results sometimes, so that's what it is there. So those are a couple of our strategies. We have a ton of strategies. It'll take us forever to get through all of them. But those are some of the newer ones we're working on, our martingales. I showed you our diversified leverage. This one we've been doing for quite some time. This one's pretty simple. And basically it owns these assets: TQQQ, UPRO, UDOW, TMF, UGL, DIG. If you trade a lot of stocks, you probably recognize these symbols. They're all leveraged. They're 3x leveraged ETFs. TQQQ is leveraged NASDAQ 3x. We put 20% of our money into that. UPRO is a 3x leveraged S&P 500. UDOW, 3x leveraged Dow Jones, 10%. TMF is 3x leveraged bonds, U.S. Treasury bonds. I think specifically 20-year Treasury bonds. Then UGL is 3x leveraged gold. DIG is 3x leveraged oil. Right, and I wanted to have commodities in there, but oil is probably the best commodity. So the whole idea for this algorithm, diversified leverage, came from Ray Dalio. You know Ray Dalio?
Of course.
Yeah. Yeah. So he has something called the All-Weather Fund, right?
Yeah.
Where basically what he does is he invests, our ratio is a little different, right? He has a different ratio that he puts things into, but stocks, bonds, commodities, and gold, right? He invests in those things and he keeps them diversified. And when they go out of whack, they readjust it, right?
Okay. Every how often do you think they readjust?
I don't know exactly the details of how they readjust. I could tell you ours readjusts when the percentages go out of whack. We have something called a drift. So if the drift goes beyond a certain point, we'll readjust it. I think that's the best way of doing it because, people will readjust like once a month or once a year. Like, why? Why once a year? Like, that's such a random thing. Like, you should be readjusting when things have gone out of whack, right? 60-40 bonds, right? People readjust that once a year. Well, no, you should if the stock market crashed, right? Then you should readjust, right? You should put more money in stocks. That makes more sense, right? So that's what this thing does. Simple algorithm, makes good money. It's made me money over the years, right? Back test results are quite extreme. You could see S&P 500 just looks tiny compared to it. That's the S&P in yellow, right?
That's ridiculous. That's incredible.
Yeah. Pretty.
Do you think that drawdown is a little too extreme? That max drawdown probably came from COVID, right?
Yeah, yeah, you could see it here. We could actually do
COVID whiplash.
yeah, so we can look at the PDF here. This is in our strategy library. You can go through any of this stuff, right? You can really get into details. So we could actually go into here. This is the underwater plot. This is what happened. So COVID, yes, that was a huge drawdown, probably the maximum. But then 2022 is also a pretty big drawdown as well.
Wow.
And I personally, I think the reason why is because both bonds and stocks got hit at the same time.
I see. Yeah.
Right? Because this thing, the reason why it makes money is because it diversifies. But 2022 is just happened to be one of those years where bonds and stocks went together, right? So that's actually pretty unusual. So that had a pretty big drawdown. So yeah, you can see it there. You can see performance by month, right? There's all these little breakdowns you can get by year, right? Look at this, 2010 to 203%. Holy crap. Single year. Right. Wow. Yeah. Yeah. It's super good. Yeah. Yeah. You get into a lot of details, all this stuff. This is what I love about being able to do things with computers, right? Is because you can get into the weeds, you can back test these things, understand what you're getting yourself into. You know, back tests aren't perfect. They're not a crystal ball, but it's the closest thing I know of to a crystal ball. I mean,
yeah.
So yeah, that's our stuff. We have, let me show you another one. This one's been one that people have been very interested in lately. Rolling calls. Where do I have the rolling calls?
Most of your strategies, are they, futures, options? What do you guys provide like that?
Yeah, we've been doing a lot of options lately. Here's our rolling calls strategy. All right, this one's pretty crazy. Yeah, we've been doing a lot of options specifically because it allows you to take leverage, right? Stocks, like without leverage, it's kind of hard to make like really extreme strategies, right?
Yeah.
There's only so much you could do with it, right? But options allow you to take leverage, and they also allow you to do like more fancy type stuff. It's not just like futures and you're just 3xing something, whatever. Options, you get 3x something, but then you also can like change your risk profile on the other side because they have floors to them. Like you're only going to lose how much you put in. So for example, this is a very simple options trading strategy. Okay. All it does is once a month buys a call option and holds it for a month. That's it. Very simple. So today I'll go in, I'll buy a call option on the QQQ. And then in a month from now, when it's about to expire, I'll sell it and I'll buy a new one and I'll hold it. Right. And that's really simple. And you think, well, why the hell does this make so much money? Well, for two reasons. First of all, because it adds leverage, right? So in essence, you're kind of leveraging the S&P 500 or the NASDAQ. So that's why you're getting such big returns. But it also has another really interesting profile to it because the way the options work is you're not going to lose more money than when you put in. That's not how futures work, right? Like futures, if you leverage it, you can lose everything in your house. You know what I mean? Like they could come after you for money that you didn't even put into the broker, right? Like that's possible. With options, you're capped at a loss, right? So this takes 10% of the account, right? 10% of the person's account, and basically puts it into this call option, right? And then in a month from now, it does the same thing, 10% again, 10% again, right? And what that ends up doing, and the rest of it, you basically just sit in like, just collect interest, right? So it's like a barbell, right? 10% is super risky, 90% is super safe, right? And that super risky part, it's either going to shoot through the roof or blow up, right? So for example, when we're looking at it here, this is around COVID time. You see COVID killed the stock market quite badly, but ours didn't actually get hit that bad.
Wow.
Right? Because we only had 10% of our money in there, right? And when that happened, you only lost 10% of your account. The entire stock market dropped 30% in like a month, right? Whereas this thing only lost 10% in that same month because it didn't have more at risk than that, right? So you're able to avoid these like really fast drops, right? Like a COVID type drop. So if a 1987 happened all over again, right? There's a flash crash happened that year, right? It's the year I was born. happened to be this giant crash in the market. Yeah. I think the stock market dropped like, what was it, 30% in a day or something stupid like that, right?
That's rookie numbers, man. That's
Yeah.
rookie numbers.
Crypto, right? For crypto, that could be, drop percent a minute. But yeah, that's what makes this strategy pretty interesting. So yeah, we've been doing a lot of option strategies, and that's kind of the reason why. You can do all these really interesting risk differentials, all that kind of stuff. So yeah, so that's a glimpse into our world. Couple of them, but yeah, we got a bunch of other ones too. There's so many that we're building out and like we're researching, and we have Bollinger Band strategies. We have like all sorts of stuff. Yeah, that's kind of what we do.
You guys are on it. This is so impressive.
Thank you, man. Appreciate that.
Not only is trading and not only is finding these strategies really difficult, but sometimes you could have the winning formula and it's the execution that breaks it down. Almost like the human element of like, okay, this is all I got to do. But then you imagine other things or something spooks you, whether it could be a friend telling you something you saw in the news. You're looking too zoomed in at the chart. I gotta sell. And yeah, it's so easy to mess it up. So not only the algorithmic side, but your guys' expertise on building these systems, it's really beautiful to see it in action, and seeing the live results, and really impressive. I mean, those returns, it's nowadays, I think a lot of people are a little antsy or impatient to make returns. Like they want to 5x their money tomorrow, but even those algorithms that you had making 30% a year, 40 or 50% a year, if you could hit that consistently year after year, some of the people that have really amassed a big wealth, starting from small, they didn't buy a meme coin and, get lucky, but they were just consistent. And they knew how to don't get wiped out, stay in the game. And
Absolutely.
Yeah, that's incredible. We have to have a conversation because this is really impressive.
Thank you, man. Appreciate that. Yeah, we've been working on this a long time, and I wish I could take credit for making all these strategies, but the truth is that it's our community that's actually creating this, because we have all these people joining our Tuesday calls on a regular basis. We're constantly innovating, and it's not just my ideas. Like I'll come up with ideas too, but people will bring their own ideas, right? They'll say, well, I have this new thing I want to try. And this whole condor martingale thing, this was one of our students came in. He's like, well, I heard this thing's making a ton of money. Why don't we create it? Okay. Right. And like, that's kind of just what started the whole thing. Right. So yeah, I mean, I think it's a wonderful thing having our community like this. And I think that's really the power behind what we're doing here, that we're able to innovate and come up with ideas like this. Right?
Let's say someone comes in with an idea from the community. Mm-hmm. It gets created. It works very well. You guys tweak it. Is there any sort of profit share? Kind of like royalties in a way?
Yeah. So we're working on doing something like that.
I'm sure that could legally get a little bit complicated.
Yeah. So right now, I mean, well, it belongs to the community. Like, I mean, if you come into one of these classes, right, and you talk about your idea and we build it during the class, I mean, it's part of the community, right? Like, everyone already access it. Like, you can't really get past that, right? So it's everyone's IP that's in the community. And to be honest with you, I think that's a really good thing anyways, because then we can all share each other's ideas. And, I think people that hold ideas so close to their chest, you're not able to like scale it. You're not able to like improve on it. Like this person that came to us with this condor martingale thing to begin with, we've been able to improve it so much. If he kept it to his chest, he would have just had his thing and maybe made a couple bucks. But then we were able to like keep, well, what if we did this? And what if we did that? And what if we did that? And it just kept getting better and better and better. Right. Mm-hmm. So that's the one comment on that. But on the other side, you do bring up a good point in that we do actually plan to make this into kind of more of a marketplace. If you join us on our Tuesday class, we build it in our Tuesday class. That's, it's a community property. But if you create your own, or you could also hire us to build something for you, we'll do this like privately on the side. When we build something like that, like for example, one of our clients right now has this algorithm that could potentially make, like some pretty wild numbers. It's a copy bot copying his cousin, who's a really good trader. Some of the numbers they talk about are like 100% in a day, so it's like pretty ridiculous. Mind you, that's if you use the whole account for the trading, but we recommend, what he does kind of like use less, but either way, 100% and you use 10% of the account, you're still making 10% a day, right? That's still pretty extreme. But he's one example of a person that actually wants to sell this to other people, right? They've built this algorithm, it's working for them, right? And then, what if they could also lease it out to other people? They can make more money to reinvest in it. It kind of becomes almost like not a hedge fund, but it becomes a way of sharing knowledge or of licensing things out like that, right?
Yeah.
So we are working on a model like that where where the community will be able to share algorithms, right? I think there's a lot of power in that.
Very interesting.
Yeah,
I love that. There's collaboration, which I love. There's competition, which can get a little nasty, but it's nature at the end of the day. Like there's competition within ourselves happening, every second.
Yeah.
But then that middle ground, whether you want to call it co-competition or collaborative, whatever. Yeah, you mix those two words, collaboration, competition, and I think that's where the magic happens.
Yeah, I agree. The way that I look at it is I actually think of like, this is kind of how it's Kodak versus Instagram, right? Kodak, everything was proprietary. You had to like get things specially made and whatever. And that's kind of what the hedge fund industry in general is like right now, right? It's like your own proprietary stuff, like to the point that, some of these hedge funds, and I know yours isn't like this, but there are other funds like this that like, if you put on LinkedIn that you work there, they will fire you. Like it has to be like you can't tell anyone you work there. Like everything has to be super secret, because what happens is recruiters find these people and they try to pay them money to either take them to work at another firm or just pay them to learn about their strategies.
Yeah.
So like there's a lot of that happening. So they're very, very secretive. But I actually think that model is starting to break down, right? And I think it's breaking down because of the way that the internet's working, how collaborative the internet is. And it happened to Kodak, right? And I think it's going to happen right now to the hedge fund industry as well, where this more collaborative nature, this way of like sharing ideas and all that, will lead some companies to be way bigger than any of the existing hedge funds right now, right? That's what I'm thinking. That's what we're building, right?
I love that.
Yeah.
Cool.
All right. Awesome. Well, happy to show you some of this stuff. We're 38 minutes into this. We're trying to keep them a little shorter. Any last questions, comments, thoughts before we sign off?
No, not at this moment. The only thing is, where can I learn more? And I would love to hop on one of the Tuesday calls. And
so if you go to our website, lumiwealth.com, you can take a look at our plans on here, right? We do have, these are our plans. You can scroll through and, so we're back testing the stuff that we talked about today, right? We have it on our website. See some of the results of them actually going, right? Here's our plans. This is the pricing depending. The pro plan and up has that ability to do that, right? We could join the Tuesday class, collaborate and all that. But we also do give out a lot of free stuff. So if you go down our website here, you'll see at some point there is our mailing list, right? If you join our mailing list, we actually open this up to the public once a month, right? Our creation process. So we did this actually last Tuesday. We went showed a bunch of other people. They joined in and saw this. We actually even now we're starting to go like live on YouTube and live on whatever. So if you subscribe to the YouTube channel, I don't know what exact channel we're putting this on, but subscribe to the channel Tuesday nights. Once a month, we actually do a free session. You can just listen in and see kind of what we do and how these things get created. Yeah.
Cool, man. I just signed up. Let's do it.
Very cool. Awesome. All right, man. Well, it's been a pleasure. Great speaking with you.
Looking forward to the next one.
Looking forward to the next episode.
This was great. Thank you.